When we first set out this, which was before the summer, looking at debt, it was very much focused on the transition to green and how that's being financed. But obviously there have been some significant changes in the market, and so we'll also give everybody an update on where we see the market at the moment, which is absolutely key, I think, in terms of the financing side, both from a lender's but also a borrower's perspective. For those that don't know me, my name's Richard Betts. I'm the publisher at Real Asset Media. We run this stand, which is just a way of being able to share content, insights, research, thought leadership across different markets, and welcome as well to everybody who's joining us on the live stream. One of the interesting things is that we can share those insights both with everybody here but also outside of the room as well. So if you've got any questions, it's a very relaxed format. Either type into them in the Q&A or just raise your hand or let me know, and we'll try to cover those while we're here. But let's just start with some quick introductions. Duco, over to you. Quick introduction of yourself and what you do.
Thanks, Richard. Pleasure to be here. Thank you very much. So I'm Duco Mook. I'm heading the Treasury and Debt Finance Department of CBRE Investment Management in Europe. So responsible for arranging that, managing that, bank relationship management, and at asset level, fund level, or anything in between. And here today at the panel, I will share the borrower's perspective.
Super. Carrie.
I'm Carrie Hartle. I've just joined Schroders real estate debt platform. We're a new platform. We started about a year ago within the real estate capital team, and I'm responsible for origination, sourcing, and execution of new transactions.
Great.
Hi, thank you, Richard. So I'm Richard Craddock. I work in LaSalle's European debt investments business. I've done so for the past 3 years. Before that, I was an ex-banker. This is like a confessional. So I spent a while with a variety of different North American and European banks working in real estate lending, primarily on the origination new business side, but also doing some distressed debt NPL workout post-global financial crisis. So LaSalle European Debt Investments platform has been around for about 12 years now. In that time frame, we've raised and deployed about 6 billion of capital across sort of pretty much a broad spectrum of real estate credit products in Europe. That covers senior loans, it covers whole loans, it covers mezzanine finance, as well as investment and development lending in all of those sectors. We're pan-European, so we cover Western Europe, but we include in that the Nordics and south into Iberia, and then across the UK and Ireland. And then again, from a sector perspective, we're, as long as there's a bricks and mortar angle, we look at it. So we cover obviously core commercial, but we also do more operational sectors, hospitality, student housing, and PRS, etc. At the moment, we have about 2 billion of capital across our various different mandates to deploy, which is a combination of commingled closed-ended funds and also separate accounts. That's me. Thank you.
Okay, great. So interesting mix across the panel here. Let's start with you, Richard, actually. So just in terms of, if we were here at Expo last year, we would have had a very different conversation. How do you see the markets at the moment? I suppose, what do you make of, I guess, the last 6 months, even the last 2 weeks, depending on what you're saying. But I suppose, how would you characterize that? What do you see, are the key kind of messages coming through from that?
Yeah. So I was here at Expo last year, and there was certainly a lot less people here than this year, which is great to see. So, I guess to put that question in perspective, if you look at what interest rates were about a year ago, so Euribor swap rates were sort of negative 30 basis points. As of yesterday, they're 270 basis points. So that's like 3 percentage point, movement. SONIA has moved about 4 percentage points in the same time frame. Really, what I think, what we're seeing is, the market going through a period of sort of introspection. As to where value sits in the context of, the new normal, which is a rising rates environment. It is an inflection point, and we're probably still quite early in that inflection point. But there's a value discovery going on. As a sector in an industry, we've become sort of pretty much institutionalized to low interest rates for the last, 14 years since the GFC. That's a long time. To be investing at negative interest rates or very low interest rates. So, at the moment the market is going through a process of trying to discover where true value is in the context of a much higher rate environment, which is driven, of course, by inflationary pressures which reared their head post-COVID as interruptions to demand and supply side have bumped up prices, coupled, of course, with the terrible war in the Ukraine and the energy crisis.
Good. And Carrie, what's your perspective on that? I mean, what do you expect to see, I guess, going forward? I mean, do you think there's going to be a pause? Do you think there's going to be less appetite? What's your sense of that?
I think there's definitely a pause at the moment, but not just in commercial real estate, but across financial markets. We've seen record levels of redemptions in equity markets in the last 8 weeks, and that has caused the inevitable reduction in portfolio valuations. So, tremendous volatility, and therefore any new capital to be committed to real estate, commercial real estate lending, needs to be, we need to have the market settle before new capital will be committed. That said, the features of our market really do remain interesting to institutional investors, and they totally get it. We have, we secure contractual cash flows secured against, real assets, typically on 5-year trajectories. We have a market that is pretty flexible, actually, where we can respond to different, aspects of the cycle. So we can lend fixed, we can lend floating, we can lend at different LTVs and different returns. So the investor appetite is there and it's sustainable, but it is definitely paused. At Schroders, we expect that the interest in real estate debt will pick up quicker than equity. This is, mainly because when you look at the returns on a purely net basis, considering the tax efficiency of debt instruments, it's pretty compelling, and that interest will start really in whole loan and high yield strategies.
Okay, good. And Duco, it'd be good to get your perspective from the borrower side, just in terms of how you're seeing the current market.
It is challenging, right? I think the market is clearly on a pause. Syndication market became on hold basically pre-summer and is still on hold, so bigger tickets are difficult to syndicate. We see there's a big gap between sellers and buyers basically, so that needs to settle down. What I find particularly difficult from a borrower's perspective is not only the rising interest rates, but also the volatility in the market. So clearly, if interest rates would be at 4%, and it might have a negative effect to returns, it will settle down over time. The difficulty, however, is that the central banks remained, they are hiking, yes, absolutely, they have continued and announced to hike, but every time they're being caught up by revised inflation figures, which are higher than expected, and they need to hike more and faster. So that creates additional volatility in the market, and that's from a borrower perspective extremely difficult to manage, right? Because again, if it would be 4%, you at least know what to put in your underwrites. But if it's 3% today, 5% tomorrow, and you don't know whether you will end up, that's for me at least the most difficult to manage.
Okay, good. And Richard, do you think there were already signs of this earlier? I mean, is this something where it's been a real surprise to the market, or do you think this was beginning to happen already over the summer, or there were signs of this earlier on in the year? Well, because it seems to have accelerated much faster than everybody was expecting.
Yeah, so I mean, I think so. The Fed started hiking rates first, as they typically do, and then others followed quite shortly after. Sweden followed, the UK followed, and then Europe lagged a little way behind. That has gathered momentum, and probably the central banks have been a little bit behind the curve in trying to address inflation. I think a lot of central banks thought that inflation would be short-lived. It was temporary inflation. It was caused by a bounce post-COVID on the demand side. Obviously, then events in the Ukraine unfolded, and we've added to that inflation with an energy crisis. Do I think there were challenges in the market other than the sort of inflation and interest rates? Probably not. I mean, if you look back on where the market was, Expo last year, occupational activity was strong. Corporate insolvencies were few and far between. Unemployment was low. PMI was high. So there were all the telltale signs of a sort of fully functioning market. So I do think this is a rates inflation and then rates-led, readjustment. And to Duco's point, it would be preferable if this was a band-aid that was ripped off. inflation was kept. We knew that inflation was then under control where rates are, and then if rates remain flat at 3% for Europe or 4% for whatever UK, whatever that might be, the equity market can adjust and people can get visibility and transparency on where values are, and the market can return to some degree of functionality sooner.
Okay, good. And I mean, I was mentioning other ones that we appear to have almost, last year at Expo Real, everybody pretty much was having to wear a mask unless they were in meetings. But this seems to have now been forgotten, and everybody is talking purely about what's happening in the financial side. But were there some things, do you think, Carrie, that have stayed on, short-term, medium-term, longer-term kind of things from the crisis, the health crisis, that I guess have changed somehow either the investment landscape or particularly this debt side?
Well, I think it's too soon to tell if the pandemic will have long-term consequences within our industry, but it's pretty obvious that it affects different segments of the market differently. We saw the immediate, and dramatic fall in hotel, in the hotel industry. But I think everyone was pretty surprised at how quickly the rebound was. Across Europe at the start of the year, occupancy and ADRs had hit pre-pandemic levels, and I don't think anyone was expecting the rebound to be that steep. And then it's obviously affecting offices very differently. But prior to the pandemic, we used to have a conversation about the future of the office, and I think the pandemic has accelerated the use of technology and requires a flexible working model. But I think no one is in doubt that effective business practices need a place for their teams to come together. And so the future of the office, I think, is pretty sound. It's just the way we use that is evolving and has been accelerated as a result of the pandemic.
Okay, good. And Duco, it'd be interesting just to get your sense, I think, I know it's difficult to look forward in a way because there's an amount of uncertainty, but you've been in the market a long time, so I suppose, what do you see and how are you adjusting your strategy as a borrower for the current situation in the market and where you see that heading?
Yeah, so I think the first question is, how long do you think, if the market is on a pause, how long will that pause remain? So I think Q3 valuations is a good intel, but it will take a bit more time, right? It will probably take more towards year end. Does that mean no transactions at all? No, absolutely not. I think we, within CBRE IM, we would continue to buy resi, for instance, but then for the long hold. We look at the right opportunities, for instance, on value add. But once there is that Q4 valuations comes in as well, and the trend will be clear, I think, new year, fresh start, some parties with a new balance sheet, new budget, it will open up transactions again, absolutely.
And it'd be interesting, Richard, maybe starting with you, and interested to get your view on it as well, Carrie. What are you seeing in terms of, because obviously from the alternative lending side, you're therefore raising funds in order to be able to then put that out as debt. What are you seeing on the fundraising side? Is there still appetite for debt funds? What's the situation there?
Yeah, look, I think whenever there's macro uncertainty, fundraising becomes more challenging, whether that's debt, whether that's equity. LPs are, quite rightly being cautious around the market and what, the near-term prospects look like for real estate. Look, what I would say is, sort of to echo, some of Carrie's comments earlier, is we really believe in real estate debt as an asset class. We are by and large floating rate product. So unlike some, corporate, public corporate debt, which is by and large fixed rate, real estate debt is floating rate, and it's typically floating rate on a 3-month basis. So, you capture that uptick in returns if the rate cycle continues to rise. We as a real estate lender, you also benefit clearly from there being an equity cushion ahead of you. So, we think that helps particularly if you're going into a period of, more asset price volatility. So I think where our focus is on the moment is growing our senior secured strategies, which we've been deploying for the last 4 years, and we're also looking at raising more capital to support a green credit strategy, which I know is the subject of this panel. I'm sure we'll come to it.
Yeah, no, we'll definitely pick up on that. And obviously the interesting thing there is you've kind of got two clients. You've obviously got your clients who are the institutional investors in the fund, and then your borrowers. And I suppose it'd be interesting just to see how you're seeing sentiment from both of those at the moment. I don't know whether you want to pick that up, Carrie.
Well, in terms of our investors, the attraction of the market is that it's relatively stable. I mean, the financing market is a €1 trillion market, including the UK. We lend for 5 years. Every year, there's 20 billion of financing activity turning over. That's very compelling. And so, regardless of where you are in the cycle, having secured against real assets in such a large market where the banks continue to retrench since the global financial crisis has been year on year, that we don't see an issue with the long-term sustainability of fundraising within our market. We just recognize that right now is not the time to commit new capital when you have no idea what the rest of your assets are clearing at.
Okay, good. And it'd be interesting, I mean, from your perspective, Duco, has there been a change of strategy in terms of, because obviously we've got increased financing costs, we've got interest rates rising. Does that change how you're using leverage? And do you think that's the case also for other investors about how they're going to use leverage going forward, whether that's for the short term or the medium term?
Yeah, absolutely. I think hedging strategies are more important than ever. At least the decision you make, right? Do you want to stay floating if you have an inverse curve, for instance, in the UK, or not? Do you want to stay, what kind of hedging do you want to conclude? Do you want to go for fixed rate loans with less flexibility or not? I think these decisions are more critical than ever. The debt yield, the forward-looking NOI, your refinancing risk, right? I mean, that's more important than ever. So we as a borrower, we stress test our own loan book to define that refinancing risk, to have an open dialogue with your lenders. And then, this is also the time for the lenders to really show basically that they're relationship driven and that they're stick to their client to support them as well.
Okay, good. And and obviously a lot of the time when you get to these kind of crisis points to a certain extent, the traditional bank lenders tend to step back a little bit, be slightly more conservative. So do you see that, Carrie and Richard, as an opportunity in the market, particularly for the senior lending side, I suppose?
Do you want to start? Okay. Yeah, so I mean, look, the European non-bank debt fund model really was born out of, post GFC, where there was less liquidity in the market. Traditionally, the European markets have obviously been a very bank-centric lending market. So look, when there is less liquidity in the lending markets in general, then look, there is an opportunity for non-bank lenders to grow market share. So Duco is suddenly being very nice to me. I've noticed this expo. But at the same time, we also, as a lender, we feed off transactional activity, right, in the market. So to the extent that transactions are down, then I think we all lose. Yeah.
Okay, good. Did you want to pick that up, Karen?
I was just going to say that compared to the, the gap funding requirement following the GFC, the banks have, maintained conservatism within their lending practices. We don't have cov-lite loans as a feature of our market, and the equity cushions are still there. So the requirement for kind of gap funding or mezzanine capital is probably not as pronounced as it was, when we were coming out of the GFC in 2012.
Okay, and Richard mentioned there the senior lending side, Duco. So are you tending to look more towards I guess the alternative lenders rather than banks at the moment? What's the situation there? Or is it a mix, or how do you play that?
Well, it's a mix, but I agree basically that this is an opportunity for non-bank lenders, right? This is about liquidity, and this is about the price of liquidity. To start with liquidity in general, the conservative banks, let's say up to a year ago, easily 60 LTV bullet loan, they need to adjust their models, right? They need to adjust their models to safeguard for rising interest rates. They are cash flow driven. If it doesn't work, then there's a limit. So as a result, their maximum LTV for bullet loans will go down. So are they closed for business? No, absolutely not. They will stick to their clients. They will try to support, but they might ask earlier for either amortization or or lower LTVs. And it's true that there will be an opportunity for non-bank lenders to step into that gap.
And as financing costs increase, plainly that means presumably that we're going to have to see yields pushing out to match that. What's your sense of that, and will that be temporary while we've got these interest rates, or do you see the interest rate horizon staying where it is at the moment? What's your view of that?
Yeah, cost of debt is obviously two factors, right? One is the interest rates. I already mentioned the volatility. That's extremely high over the last 6 months if you compare it to normal previous years. So that needs to stabilize. If you look at, for instance, the volatility index or the VIX, it's incredible volatile. Again, that will have an effect on lenders and liquidity costs as well. And then we have the interest rates. So interest rates need to stabilize as one element. Then lenders' liquidity cost. I think if you speak to the German pen brief banks, it hasn't increased that much, right? Other banks, investment banks, are affected more. Again, I mentioned the lack of syndication. So certain banks who, out of business strategy, they want to provide full underwrites, big tickets, syndicate thereafter. They now have an issue with their strategy. Conservative banks, international banks like the Santander in Spain, they are market leader in that area. They will continue to lend and they will continue to make their book. Will it be more costly? Yeah, probably there's an upward shift on the margins as well, but not as much as on the interest rates, of course.
Okay, good. And there was a quote that I've used before in these sessions when we've looked at debt, which is that debt is like a superfood for the real estate markets. But is that still true at the moment? Is it only a superfood for some? Is it not at all a food for others? I mean, are there going to be, which situations is it going to make sense to seek leverage? Are there some now where it's not going to make any sense at all? You've obviously got to be deciding where you're going to be lending. So I guess, how do you see that? Where are the opportunities to lend, and where do you think some parts of the market will close off for the short term?
I think where you see structural change. So obviously there are issues with affordability on residential, and that should fuel the BTR market. I think we believe quite strongly in the PVSA market in Europe, where good university cities are, it's quite obvious that they're undersupplied. And then just the sheer cost of bringing buildings into an ESG compliant criteria will require capital from more higher yield or whole loan strategies that can take development risk, within and push further up the risk curve, say 70-75% loan to cost, where that will fuel a lot of the market in recapitalizing these buildings.
Okay, good. I mean, that brings us in actually to the topic that we'd picked up, which was the financing the transition. So let's just pick up your kind of views on that. What's the strategy behind that? Where do you see the opportunities, Richard?
Yeah, so look, I think at LaSalle we're definitely on a journey when it comes to ESG, which I think most of the industry are also on. We commit a lot of resource and a lot of time to trying to navigate, the ESG landscape. We have a team of 13 plus people who are full-time, who focus solely on sustainability. So we are learning. On the debt side, we're rolling out, a number of initiatives, including enhanced ESG due diligence on underlying assets, including adopting third-party climate risk models, including trying to leverage as much of the intelligence we can get from our equity business as to what they're doing with our direct assets that we own, to try and help work with our borrowers, and add value to the financing process by, trying to sort of steer them towards what we think might be best practice for a particular asset in a particular jurisdiction. Look, we think there's a big opportunity to fund, the decarbonisation of European real estate. I mean, the numbers are pretty staggering. So, the EU estimates that the total capital required to decarbonise European real estate is about 275 billion a year through to 2030. So these numbers are big, right? So we see this as a sort of, almost a once in a generation, regulatory driven opportunity, where, we can come in, provide capital, work with our borrowers, to deliver sort of next generation real estate. And we do it, I think, we do it because we think, that there's the big opportunity set out there, but we also think that assets that are clearly, high performing from an ESG perspective will drive better value, will drive better rental tones, will drive occupier demand as the whole corporate universe seeks to sort of align their own physical real estate space with their overall net carbon objectives they're making at the top of the house.
Okay, good. And Duco, how does that play out for you? I mean, obviously as a house, CBRE investment managers focused on ESG, as are all investment managers in essence at the moment. So I suppose, how useful is it to be able to have that pool of debt available? Are you looking to transform assets? Is it that you will buy new and sell off the brown in order to stabilize the portfolio? What's the situation? What are you aiming to do? And I guess how are you going to use debt within that context?
Yeah, maybe first on the equity side. So all our open-end vehicles, they have ESG strategies. They have, a clear green framework in place. They work with external parties like Sustainalytics and what have you to define their ESG ambition. So on the debt side, we try to mirror that. So secured lenders, ultimately, a green financing or a sustainable financing is still a tailor-made product between borrower and lender. We see the non-bank lenders getting more active, although they're a bit behind, let's say, compared to the international corporate lenders. We spoke to many banks today and also, in the coming days. All these banks, they have their targets to, in a couple of years, at least have, is it 25%, is it 1/3 of their loan book classified as green or sustainable. So it is a strong urge from within the whole business on equity on that side to grow that as well as on green financings and sustainable financings.
And that's interesting. I suppose it'd be interesting to get a sense of just what some of the challenges are, to be able to recognize, but also then deploy. So I don't know, does anybody want to pick up what the challenges are there?
I think that there's been a lot of discussion about like a green premium or a brown discount, but where, from a debt perspective, where we're leading to is that liquidity will only be available if there is a sustainable business plan, and we're an Article 8 fund, so we have listed hurdles in which all of our loans have to hit, both in terms of data capture, ongoing, carbon levels to be sustained, as well as not just hitting the E but also the S as well, and looking at employment and creating communities within within the jurisdiction, so within the assets jurisdiction. So we have like a pretty encompassing business plan that is still evolving, and we will see that kind of play out over the next few years.
And that picks up the social side as well, very much by the sounds of it. Richard?
Yeah, I think so. From our perspective, there's a couple of big challenges out there, and I think this is common for debt or equity. So one is data and the ability to capture data, monitor data, harvest data, and there's a challenge with extracting energy consumption from underlying occupiers. So whilst landlords now, are all very collaborative in providing whatever data they have, they can't, you can't force a tenant unless it's in their lease to provide you with that data. But I think the industry is waking up to that, and green leases are now becoming more common, and I think occupiers are now beginning to see the benefits to them to actually providing their landlord with and tracking their own energy consumption. I guess the second point I'd like to raise is probably the sort of death by acronym that the ESG industry is currently suffering from. So whether it's PRI, NZB, BPP, GRESB, whatever it is, I could go on. All of them wonderful initiatives and organizations, but it's incredibly confusing for the layperson who's, the reality is we and most of the industry participants are trying to focus on the ESG agenda on the side of their desk, whilst also doing their day job of buying, owning, managing, selling real estate. So to my mind, there really needs to be a consolidation within Europe and probably global sustainability that seeks to have one single set of commonly adopted barometers for decarbonisation of real estate, and probably one single definition of net zero carbon buildings, because I think that's really lacking, and I think that would help that would help everyone realize what journey their assets are on and what they need to do to continue that transition towards net zero.
And how does that play out in terms of embodied carbon? I mean, pick that point up, Duco, if you want, but I'm interested to know how that, how do we deal with the embodied carbon side of it from a financing and borrowing perspective as well?
And maybe firstly to respond to Rick, I recognize that point as well, right? I mean, we have concluded many green financings as well as sustainable financings. Sustainable financings typically have KPIs with a certain strategy. You need to measure these KPIs. You need to meet these KPIs. If you do KPIs on a bigger portfolio, like a revolving credit facility at fund level, you don't know yet where you will acquire these assets, right? So typically you see assets need to perform a certain BREEAM score or what have you, but if that certificate is different in the Netherlands than it is in Sweden or in Germany, how can you meet that KPI? So I would definitely welcome more alignment in that field. A challenge, I would say a risk. A risk is, I think the debt capital markets is more advanced in terms of ESG. Why? Because you have multiple fixed income investors. They will challenge you clearly if your green ambitious is not enough. So you can simply not make a green framework but being not ambitious enough and to do a green bond. So a green bond is really, it says something in today's market. It has that layer, that certificate already on top. If you do a green financing on a secured level between one borrower and a lender, it is still tailor-made. There's loads to gain, there's loads to improve, and that will develop over time. So from a borrower perspective, I think there's a risk if your assets are brown that at some stage there will not be any liquidity to leverage it. So it can be that you can finance a brown asset with a certain strategy to make it green. Yes, fine. So then it's a bit of a repositioning loan. All of that will be available. So it's not that. But if it's only, let's say, without a strategy to change it and it's only a brown asset, I fear that it will be, a policy point of view for certain banks to say then we will not provide any debt at all.
And the deadlines are not far off, right? So this is why the real estate industry has been a bit of a sleeping giant. It's only really just awoken. So, but you think about 2030 Paris Accord objectives, right? I mean, that's 8 years away. That's one private equity, real estate investment cycle. From 2027 in the UK, you can't let a building that's worse than EPC C or below, right? These deadlines are really imminent, and which is why. The ever rapidly gaining momentum of the topic, within the real estate sector, and we're big as well, right? I mean, we're like 40% of the world's, global carbon emissions. I mean, to put that in perspective, aviation is less than 2%, right? So we are a behemoth as an industry, and we can affect quite a lot of change.
And do you think I'd be interested to know in terms of things like development finance, because there's a similarity in some ways between the sorts of transition that you may have to make to some of these buildings to development, because there's a lot of retrofitting, there's a lot of activity that needs to be done. I suppose, how's that likely to be priced? And what do we see at the moment? Because development finance at the moment seems to be quite difficult to achieve anyway in the current market. So I suppose, what's your sense of that? I mean, are you looking for, how do you see that development side, Duco?
Yeah, it will be interesting to get the view from the non-bank lenders, to be honest, on development financing, whether that's available at all. I think there's probably a distinction between asset classes. Like I said, we would love to acquire more resi, but a development financing for resi, typically you need to get your permits, you need to start, you need to buy the land. It can take 3 to 4 years, right? So the question is, do we as a buyer want to take that risk in 3 to 4 years about valuations and completion? Versus logistics or other asset classes like logistics, in 9 months you can be done, right? So probably that's more achievable today than a longer hold and slowly start a building scheme.
Okay, good. If anybody's got a view on the more development financing side, let me know. If not. But I'm also interested just to pick up on, we've spoken a little bit about the carbon side, so the E, if you like. But what about the S? I mean, there's a sort of growing focus in general also from the capital around social initiatives, more social impact funds being set up. So I suppose, what role does finance have to play, particularly in that area?
I'm happy to start, if that's fine. I mean, again, the sustainable financings that we concluded, they have 3-4 KPIs. Up to now, let's say 75% was focused on green, but we see more and more a KPI linked to social as well. Probably best example is around social housing and the level of the rent that you ask and the bucket of social housing in your portfolio. But we see growth in that field. Yeah, absolutely.
Okay, good. Any views from this side on the social side? You mentioned it a little bit earlier, Carrie, but
I think it filters into the counterparties you deal with. So you see a kind of a leveling up of the borrower universe. So, we have our own social agendas at Schroders, and our investors expect us to, meet certain diversity hurdles, as well as, looking at who our counterparties are and ensuring that their view of the world aligns with ours. And so I think actually it just creates a bit more institutional, like a more institutional market that's looking, not just at the cash flows anymore.
Yeah, I mean, it's funny, isn't it? So we put these three letters together as if they're sort of natural bedfellows, but they're really very different challenges, right? So like, I would say capital E, very large capital E, and then sort of slightly smaller S, and then sort of slightly smaller G, in terms of the challenges I think facing the sector. I mean, it's, to Duco's point, social housing as a sector, we're looking to finance more. We try and focus on when we are funding assets, that they are thinking about how they create the right workspaces, and obviously BREEAM and other rating agencies look at how they create the social factor as well, which I think is also coming a little bit organically, particularly post-COVID, right? So it's, an office now needs to be, all singing, all dancing, having a slide, lots of common areas, lots of interactive areas, for Gen Z or Y, or forget where we are, to attract that kind of talent into the workspace. So I think that is happening organically, as well as it being a focus of investors.
okay, good. Does anybody have any questions that they want to ask? Yes, go ahead. Can I just borrow yours a second, Duco? There we go.
I think it's very interesting thinking about all the investments that need to be done into the real estate sector to follow a pathway to net zero. And a lot of these investments that are the low-hanging fruits have already been done. And there's a lot of investments coming up that are very costly. And I think investors into your funds, for example, might reason that we don't want these investments because we don't see the return on the time scale we're looking at. So it's almost a conflict of interest in terms of what needs to be done and what is financially the best investments to make. How do you see this conflict of interest?
Does anyone else have a question? We'll take them all at the same time. No, let's. Does anybody want to tackle that?
Let's start.
Duco, I better give you your microphone back then.
I think it's all about conviction, right? I think, take Resi again as an example. The investors also need to think about, in 5 years from now, in 10 years from now, you might want to dispose that asset. Is there a market for brown assets in 5 to 10 years from now? So this is not only about returns on the short term, but also take the longer view, in my view. So yes, absolutely. And our investors, they are truly believers of the ESG element as well. Yeah.
I think it's a really, really good question. So, it's all very well building a brand new, shiny, City of London or Berlin office building that is highly energy efficient, and calling it green. But the challenge is really the long brown tail, right, of real estate assets out there. In major gateway cities, there's a viable economic argument, commercial argument to commit capital on those assets, to transition them, because you'll capture it in the rents. But in smaller regional cities and towns where, the reality is the real estate value just isn't high enough, and or, the assets are too small to attract more sophisticated institutional capital, that's where we'll see the real challenge. And I'm not sure I have an answer to that, other than, government intervention and public capital.
Okay, good. Thank you for that. So I've got a sort of final question, which is, what do we think if you've got to pick one key trend going forward, what will that be? And also, I guess, from your side, where you think the opportunities are then in terms of the financing side. So Let's kick off with you, Duco.
Well, opportunities from an investment perspective. I think, again, resi for the longer hold and on the shorter term value add, cherry picking on the right locations. ESG, absolutely. And from a borrower perspective, I would say be really on top of managing your loan book, be very mindful about the volatility in the market, and think well ahead about the hedging structures.
Okay, good. Carrie.
As mentioned earlier, undersupply in PBSA in many across European cities, the BTR market, and ESG, and just the sheer wall of capital that's required to bring these buildings into compliance.
Richard.
What they said. So look, I mean, I think the next 6 months is going to be about controlling inflation. And central banks are, hiking rates to try and control that inflation. We'll see whether that is successful. If it is successful, then there's reasons to be, optimistic. So, the occupational market still remains reasonably strong. There's still a lot of strong supply-demand fundamentals in most European, gateway cities and jurisdictions. But at the moment, the market is going through an inflection process. So hopefully, as I said earlier, we can rip the Band-Aid off and settle rates into a more long-term average. I mean, rates are still low, right? Even at 3%, where it's still low versus if you look back to the 1700s, like rates average 5%. So they are still low in the grand scheme of the interest rate cycle. And then from a thematically, we still think some of the kind of secular trends that were unleashed expedited by COVID, like including e-commerce. We still think those trends are relevant today. So we're still focusing on urban logistics, and then living in all its various different sort of manifestations.
Great, very good, interesting. We've actually got a session coming up on the living sector and affordable housing later on. Next is the Netherlands. So if you're interested in the Netherlands, that'll be on in 15 minutes. So you've got a chance to chat to the speakers here afterwards, grab yourself a coffee and sit down again for the Netherlands. We've then got social impacts, living sector and affordable housing, and we'll finish off with, as I can see, that's my fault there, an incorrectly spelt logistics, global trends. And then there's networking drinks. So do feel free to join us for any of those sessions. If you are joining us online, thank you very much for watching. If you were watching this on demand, thank you very much for watching. And thank you to everybody here in the room, and thank you to all of the speakers. Thanks, everybody.